Hey everyone, it's Pranay. Super excited to chat. I know that we've been wanting to talk about deals at the kind of the end of the life cycle, whether they do well or whether they struggle. And I know I have plenty in my portfolio that have done both. Oscar, can you highlight speaker?
Yes.
Okay. So I know I have plenty of deals in my portfolio that do both. And especially, I was just talking to Tal a second ago that deals that were bought in 21, 22, a lot of them are struggling. And I've even had some deals that have gone into foreclosure. So I think it's really important to get not just my opinion on it, but to hear from an expert, someone, and a group, which I'll have them introduce themselves shortly, a group that really deals with investors, passive investors, syndicators, people in real estate, because it's a lot different than a normal type of CPA. They're just used to filing taxes, but here we really will talk a little bit about strategy and really the ramifications as not just as accountants, but people who are actively investing themselves. So I think Gelt really brings a unique perspective, and we're very excited to bring them on a second time to talk about this. So welcome, Gelt team.
Thank you. Thank you. It's great to be here again. And of course, I do hope that the future real estate projects will go much better than the ones in 2020, 2021, in general. And I'm optimistic overall. I'm optimistic about that as well.
Yeah.
But yeah, great to be here.
Yeah, awesome. So on, sorry, Oscar, on my screen, I just see my face, which I apologize if everyone else has to look at that only. Is it showing it up for speakers for everyone else or just me, Oscar?
Sorry about that. Yep.
Cool.
Oh,
I think you unmuted the wrong one. Yeah.
sorry. Who are we trying to unmute?
Could we just maybe do like speakers, or maybe we could do like a split screen so that all the panelists are available? Or,
Yeah,
or maybe we could
all
maybe we can
gathering here.
tag. Maybe we can spotlight uh Rachel, Tall, and me. You want to do that?
All right. Got
Perfect.
it.
Okay, great. Okay, awesome. Ladies first. Rachel, do you mind introducing yourself?
Yeah, of course. Hey everyone, I'm Rachel. I'm a CPA and product manager at Gelt, and I've spent my career helping individuals and businesses achieve their goals through tax strategies. And at Gelt, I am lucky enough to work at the intersection of kind of the tax expertise and technology. So, really focused on helping make complex tax strategies and topics clear and actionable so that taxes can be a tool for planning and achieving your financial goals and not so much just one big scary thing that you have to do at the end of the year.
Awesome. Thank you for that. Tal, you want to introduce yourself?
Yeah, of course. My name is Tal. I'm the founder of Gelt, and I'm quite obsessed slash passionate about taxes, depending who you're asking. I think that's the long story short.
I don't think you'll find another group, maybe people in tech that are obsessed as taxes as doctors. So we,
Uh, I'm married to one. So yeah. Also, she does not care about taxes and money. It's
oh,
she does. Yeah, very weird for a plastic surgeon.
yeah.
Um, but hopefully, once she finishes the residency, like in a year or two, it will change.
Yeah, well, she has you. She doesn't need to worry about it. I always talk to my wife and she's like, I don't have to worry about budgets. I have you to tell me about it.
Yeah, yeah, it's my problem, not her
Yeah.
problem.
Uh, okay, awesome. So let's briefly, because I know we talked about this before last time, and we can refer back that to people. Let's just talk briefly. Things go well, you got an exit, you actually made some money, and talk to me about what that kind of looks like for, let's say, $100,000 investment made in total about $50,000. So you end up with 150 over 5 years. Just generally, over a couple minutes, talk to me about the tax implications for that.
So,
For a physician, not reps, nothing, just normal run of the day person.
Yeah. Before I want to have to start with like a background of like what does
Hmm.
it mean, like what tax treatment even means when it comes to real estate and in general. When you think about taxes, you really have two components to like how you think about gains or income in general. You have the source of income and you have the activity. The source of income can be real estate, can be ordinary income, your W-2, can be business income, can be capital gains if you sell an appreciated asset. There are many types of there are many types of sources of income. Then you have two types of activity. You have passive and active. And I think that the first thing that what happens when you're starting to receive money from investments, the first thing that you want to start to determine what is this income, under which bucket is it going to fall. And it sounds like a simple task, but sometimes it's going to split between multiple buckets also. So, and there are certain provisions that allow you to treat differently certain types of income depending on circumstances. So that's kind of like the number one thing to understand, that income is complicated. Our income or losses, our gains or losses are being treated is quite complicated. And maybe just like to finalize that, and then I'll let Rachel take it from here. Like in order to offset income and losses, you need both the activity and the source of income to match, basically. So you can offset active income from active losses. If you have passive income, you cannot offset passive losses from active income. And there is a lot of what you're doing when you're doing tax optimization or you're doing planning for the future, or when you're dealing with a liquidation event or before the liquidation event, is better understanding how the income is going to be classified, under which buckets, which categories. Is there any way that we can affect this classification? Sometimes yes, sometimes no, but that's kind of like as a baseline, the way that you want to think about like you received money from investments, from whatever it is, like you need to start breaking it into the buckets and understand the activity. And saying that, like back to your question about what happens when you have a liquidation event, I'll pass it on to Rachel.
Yeah, so just to like follow up on what Tal was saying, when you're making the investment, like you made an investment and then you exit the investment. So you put money in and you get money out, and that's one part of the transaction. But everything that happens in between, so what that investment is doing, how it's earning or losing money, all of those things are ultimately going to affect what happens at the end. So with real estate activity, generally that's treated as passive activity. If you're just if you're a real estate investor, you're not majorly involved in the transactions. So if you made this real estate investment, most common activities that that investment is going to do is there might be maybe it's a project where you're developing something. There's going to be a lot of capital expenditures. So maybe not a lot of activity is happening on your K1 every year, and then at the end you're going to have a gain or loss. But on the other side, if you're investing in a rent project that has rental real estate, then every year you're going to have either income or loss from what that investment did that year. And depending on what that result was, you might be accumulating losses where when you have that exit, the losses can come up. So there are a lot of different things that can happen, and it really depends not only on what you invested in, but what that investment did every year that you held it.
Okay, so how can we, without going super deep into the numbers, uh, just for for your kind of typical day-to-day syndication, let's say you ended up with like a 50,000, so 1.5x equity multiple. What would you kind of expect to pay in terms of like depreciation recapture, if you want to just talk about that briefly, and then capital gains?
Yeah. So if you had an investment and if we have depreciation recapture, there probably was some activity, maybe some rental activity or some activity happened over the years where that asset that was being held in the investment is depreciating. So each year you're getting a benefit, whether or not, and maybe you recognize that benefit, maybe you didn't. but a depreciation is happening. So part of that real estate is being written off every year. And
Hmm.
then usually if you sell a property that had no depreciation, then 100% of that gain would be capital. So if
Mm.
you invested in something for 50,000, sold it for 150,000, you have $100,000 capital gain. And
Hmm.
capital gains are usually taxed at preferential treatments, which are lower than most people's your ordinary income taxes. So capital gains, especially long-term capital gains, are really what you're aiming for. Now, if you had a gain and you also took depreciation in those prior years, the IRS will say, okay, when you took that depreciation was taken as an ordinary deduction. So you got the best kind of deduction, and now you're getting the best kind of income. That's too good. So when you have a gain, the IRS will say, okay, to the extent that you benefited from that depreciation, I'm going to make you pay ordinary income on that piece of your gain, and then the rest you can take as capital. So essentially, you're paying back some of the benefit that you received from that depreciation in prior years. And it only happens if you sell for a gain. So if you sell for a loss, then all of your loss would be capital loss. So you don't end up getting ordinary because you already got the ordinary loss in those prior years. Does that make sense?
Yeah, yeah, and this is strictly for people that used the depreciation because there's a lot of people maybe it threw off some type of distributions, couple percent, but you
Yeah, and if
usually.
you didn't get a benefit, you
Hmm.
generally won't have to. So if you had that depreciation was maybe carrying forward, or for some reason you didn't benefit from the deduction, then you wouldn't end up also paying. It would cancel each other out in that year of sale. You're only going to have that ordinary income depreciation recapture if you truly did get a benefit from it in those previous years.
Awesome. Okay, cool. So basically, if you sell a property, you will pay capital gains, which is 20-ish% on whatever the value has increased. So if your shares, right, because we all buy a percentage of the property, if it went up 1.5x, then that difference, so 100 to 150, you'll pay long-term capital gains, which is different than short-term capital gains, which is at your normal rate. And then whatever amount, so of that 100,000, maybe you got, let's say, 50% of depreciation in the first year and subsequent years. So then of that 50%, so let's say 50,000, then you say you used, I don't know, 10,000 or so of that depreciation on your distributions. You on those distributions, you would have paid your normal income tax because it's normal income. But because you did not, so for those years you deferred your taxes, and so you got to keep it basically. You got a loan for those taxes for free. Just at the end, at the sale, you have to pay it back at whatever you benefited at, which is your normal income rate. Now, what if, so say I had that deal and I have deal two, which is sitting on $50,000 worth of depreciation, so a negative 50,000 capital balance. Am I able to offset some of that capital, that depreciation recapture and defer it even further?
So if your investment number one has a gain, you exit. What happens is if you have losses in your other investments that are carrying forward and not being used,
Hmm.
in the year that you sold investment one, you can
Hmm.
actually free up those losses or deductions that are being held in your other passive investments against the profit in your investment number one. So
Hmm.
if you have other investments that are carrying losses forward, when you do have a sale, you can free up losses, and they can even be ordinary losses to the extent that you have that capital gain. So you can so you can balance yourself out to zero. And then the investments that you don't have to sell those other investments either. And then they'll just continue to carry forward, but with less loss carry forward. So when you sell them, you would have less freed up and ultimately pay more tax. Does
Yeah.
that also make
Yeah.
sense?
So just to kind of put a bow on it, if I have investment one and investment two, if investment one sold at a profit, I can use the depreciation from investment two on the exit of investment one if it's in the positive. However, for investment two, now all of a sudden I have less losses to utilize when investment two exits. So then I need investment three, and so on. It kind of keeps going. But
Yeah.
remember that this is money that you would normally pay in taxes. You can keep that, and that money earns you more money. Eventually, when you pay taxes at whatever the full amount is, but there's no carried interest. There's no interest rate. That's why they consider it interest-free loan from the government because you will have to pay back at some point. Uh, Typically, there's ways around that. One is dying, but if you will have to pay, but if you can defer it for 5, 10, 20 years, that can be substantial. And if that's compounding at like say just 5%, that's it could be substantial and really grow a lot of net worth.
I do
I
want
like,
to add. So,
Mhm.
go ahead,
oh, I
Rachel.
was just gonna say, I like thinking about that as deferring taxes is like getting an interest-free loan.
There is another consideration that you want to take into account, and it's the
Hmm.
income level in a certain year.
Hmm.
Taxes are
Hmm.
being determined by your income level. So if you
Great
have
idea.
like a really, let's say that you're changing between jobs or you're taking a year off, you and your spouse are taking just a year off, and your income is lower, that's not the best time to utilize probably the losses because even the taxes that you'll pay on the gains might be, depending on how much money you're making, it might be lower. And you might want to pay taxes there and then wait until, if you can, until you get back to work, your income goes up, and then
Yeah,
take the advantage. So you have timing is important, and your
great
current
point.
income and future income is also important into the consideration. And nobody knows your own situation better than yourself and your own
Hmm.
plan better than yourself. Not
Hmm.
usually, not even the CPA. So if you're working with a professional, it's important to share those kind of like plans. If you know that you're going to take, like one of the spouses are going to, take 1 or 2 years step back because of kids, for example. You want to share that as you are planning because it might affect recommendations and what you can do and when you should do certain things. So it's definitely something to take into account, timing.
That is such a great point. And a lot of times we just think about, okay, what's your tax rate? What is, how much losses do I have? But the timing is is so important because even though you might be taxed at maybe you don't have many losses or et cetera, because of everything else in your life, taking time off, doing a sabbatical, maybe your actual overall tax bracket is on the lower side than before, and your opportunity cost is higher, meaning that it would be better for you to actually save those losses for later when you're in a higher tax bracket.
Yeah.
Yeah, awesome. Great point, Tal. Okay, so now, one thing that no one really wants to talk about, and people shy away from, but because of kind of where we are in the economy, a lot of people were saying that it was survive till 25, where uh, magically everything would be better in 2025. But we've seen that that's not true, and some of this pain that we're having in this real estate cycle may last longer, 2027, 2028, before we see some benefit. It's hard to say. There's so much volatility right now. It's really hard to say more than 6 months from now. The betting markets for interest rates were up to like 7 cuts this coming year, and now they're down to two, and it just keeps going up and down. So we want to talk about deals that are not doing well, or maybe even have gone into foreclosure, and how that affects real estate investors. So let's take our previous $100,000 investment. And just for the sake of argument, let's say it never sent any depreciations. It gave about 50%, sorry, no distributions, had about 50% depreciation. And now it's, let's say, year three, and the property went into foreclosure December 31st, finalized of 2025. Now, what are some things that an investor in that deal needs to think about, and what is kind of some small benefits that they have, and then they should look into for their taxes now?
Yeah. So, what's bad for life is generally good for taxes. So if your investment's not doing well, filing your taxes is probably the only time you're going to be happy about that. But in the example, if you have a foreclosure or something happens to the property, that's generally treated as if it was a sale.
Hmm.
But with a foreclosure, if that property does have liabilities, if you have a mortgage or a line of credit out on that property, that's also going to be considered when you're accounting for that foreclosure. So even though they took the property might have been taken away, your
Hmm.
loss is going to be limited by the debt that was forgiven as part of that foreclosure. So if you're in a situation where the property's underwater, and there's a foreclosure, you may end up with debt forgiveness, which could end up being a taxable event, where that income is picked up as cancellation of debt income. So it's important to know before any of these transactions happen, just exactly where things stand in terms of the financial situation and the balance sheet, to understand what that impact is going to be on your tax return.
So can you dig in a little bit more? Because I'm sure that's surprising to people. So say there's a $50 million mortgage, and then you bought it for, let's say, 60 million, so it's 10 million in equity, and the bank takes it back. Property is worth, I don't know, let's say 45. Feel free to tweak the numbers to make the math easier, but how and what determines like the forgiveness and the impact on the passive investor?
Okay, so we had a $60,000 property,
60 million.
60
Yeah.
million dollar property, 45 in
45 current value, 50 debt.
50 in debt.
Hmm.
Okay, so the property is foreclosed.
Hmm.
Originally, if you had just $100,000 and then we
Hmm.
go to 40, it was 45, the
Yeah,
current value.
yeah, current value. So say you lost like, I don't know, 20%. So
Okay.
your value
So
is like 80.
if
Yeah.
current value was 45,
Yeah.
then if there was no debt, then your loss would have been 55,
Hmm.
right? But you had that $5 million of debt forgiveness because your property was worth 45 and your debt was 50. So instead of taking a $55,000 loss, now you're going to have a $50,000 loss,
Got it.
to account for that cancellation of debt income. So on paper, you might be expecting a loss that's much higher than what actually comes through to you due to any debt forgiveness.
Got it. Okay. So you weren't talking, it is a tax liability, but it's not an out-of-pocket tax liability. It just
Right, it would reduce your loss.
reduces the losses that you'd be able to use for what would you be able to use those losses for?
So you would be able to use those losses against other capital income. You would be able to, and then if you'd be able to use them against other capital income, and then if you've totally gotten out of this deal,
Hmm.
you can usually take those full losses on your tax
Uh,
return.
Against you, and then that's on all income, right? So against your active income as well.
Yes.
Yeah, total income. Okay. So then that current value is very important, right? Because it can potentially limit the the amount of losses you got. So how do you determine how much is forgiven? Because like the bank just takes it back. Like I don't know, I don't know if they sell it, they hold on to it. How do you know what that delta is between how much you get forgiven and what your kind of capital balance is, meaning what your investment is? Because I want $100,000 worth of losses. I don't want,
Yeah.
I don't want 50.
So
Yeah.
So in the case of a foreclosure,
Hmm.
there are going to be multiple tax forms related to that event. So
Mm-hmm.
at the time of foreclosure,
Mm-hmm.
the bank's going to determine what the fair market value of that property is, and
Got it.
then the difference between what you owe them and the fair market value of that property. If the property is worth less than what you owe, then generally they'll forgive the difference. So if on your balance sheet you owe $100 million to the bank and
Mm-hmm.
they say this property is only worth $60 million, then they're canceling that $40 million difference.
Okay, and then potentially my value, if I had $100,000 investment, just very smooth numbers, might have gone down by 40%. So now maybe it's worth 60,000 worth of losses instead of 100,000. It's kind of big picture. Is that
Yeah,
not right? In that specific scenario. Okay. So very important to know what the fair market value is. So if you're in a foreclosure, to try to figure out what the bank considers that at. And that's pretty sounds like it's pretty like routine for banks to do that. Yeah.
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 Yeah, it's regulated. So you'll have 1099s and 1098s, and
Yeah.
they will definitely report all of the all of the activity related to that. Sometimes the amount of debt forgiven will also include the interest that they were expecting, in which case you'd
Mm.
also get a deduction for that interest. So it would be treated as interest paid um,
To reduce your
eventually.
losses, because that would be considered almost like a distribution. Or like it would reduce the value, kind of just like the fair market value would. Yeah. Yeah. Okay. So in an ideal scenario to kind of maximize your losses, the the fair market value would be whatever the bank whatever their basis is, meaning whatever the note on the bank on the loan is. So if it's a $30 million property, a $30 million loan, you want the fair market value to be at very least 30 million
Hmm.
to maximize your losses. Yeah.
Yeah.
That or any higher. Okay. That's good to know. Okay. What else? What else other kind of nuance do you see? Because that's really important. That fair market value is very determinative of what's going to happen. So that's something that would be very useful to figure out. And I'm going to go ask that for all of my properties that are struggling. And I think we have that. So what else do you think is kind of foundational or key that you've seen
Um,
in those kind of scenarios?
One thing that is helpful to know, it's not always it's not a common situation that can happen.
Hmm.
But if you have a property and let's say you don't have any loans out on that
Hmm.
property and
Hmm.
the property becomes completely worthless
Hmm.
for whatever reason,
Hmm.
um, usually an option is to like maybe you can sell the property, but another option that you might want to consider is if you abandon the property, which is you completely give up the rights to that property altogether. That's a way where in some cases you can turn what might have been a capital loss, which again gets limited to the $3,000. You can take against $3,000 of ordinary income per year and turn that into an ordinary loss, which could offset your W-2 activity and other types of income. So it can turn it into potentially that more valuable loss. And that's the difference between selling something and abandoning it. So
Mm.
it's not super common where you're able to you might not be able to abandon the property, but if you're in a situation where that would be something that you're considering, there is an advantage to that over selling it for a significant loss.
So, a couple of things I want to dig into. So, tell me more about this 3,000 limit. So, if I have, say, in that last scenario, I have 60,000 of losses because it lost 40% of value. The bank foreclosed on it. Uh, and I have $60,000 left of losses. Am I not able to use all of that right away?
Not all, in most cases, no. So in most cases with your capital losses, you
Hmm.
can use them if you have capital income. In other situations, you can offset your capital in 100% of your capital income
Hmm.
with capital losses. And
Hmm.
then against your ordinary income, you can take $3,000 of capital losses per year. So it can take a long time to actually get the
Mm.
benefit from all of those capital losses.
And is that 3,000 limit combined with kind of the stock tax loss harvesting and such? Is it
Mhm.
it's
Yeah,
one
so
bucket?
you can offset you if you have capital gains from stocks, you can offset those with your real estate losses because they're all in that capital loss, like
Hmm.
capital income, capital loss bucket. The things that you can't offset with capital losses would be ordinary income from your W-2 or your business that you own, for example.
Hmm. So say I have is foreclosure money like after a property has been foreclosed on and I have this, let's say $60,000 loss, is that categorized any differently or able to be utilized any differently than just 60,000 of depreciation from a property that's just chugging along? Or is it roughly about the same and you could use it for the same stuff?
So a foreclosure is treated as a sale, so the gain or most likely loss from that event will be capital, where
Hmm.
depreciation is an ordinary deduction. So that is the better kind of loss.
Mm. Mm.
That could, again, with real estate, it's often limited on whether you can actually take it every year. But if you can take that depreciation, that's an ordinary deduction or loss, which is worth more than the capital. So when you're making money, you want it to be capital. And when you're losing money, you want it to be ordinary.
Got it. Got it. Okay. So then the foreclosure losses can be used on any type of passive gains, but only 3,000 of it can be used against your active income total
Yeah.
for the year.
Yeah. And then you won't completely lose it. It'll carry forward. But in a single year, you have the $3,000 limit.
We have seen quite
Is
a few
it? Hmm.
cases that like
Hmm.
CPAs did not carry it forward,
Oh
that
no.
they just forgot about it. We
Salt
have
on the
That would
seen
wound.
be really bad.
we have seen
Yeah.
it in six figures.
Oh my goodness.
Yeah.
So okay, so what
Uh,
else do you do? Like say I mean, say my capital loss is in the six figures, which unfortunately it is on some of my deals from other sponsors. I can only use 3,000 of it. What else? How else can I get creative with using? So otherwise, like I'm gonna be like 80 before I use all of these losses. How else can I get creative in thinking about other than, exiting a bunch of properties, which probably won't happen in the next couple years? How else can I get creative to be able to tap into those losses from foreclosure?
Capital gains. Be aggressive.
Hmm. Tell me more. Like
Make
what?
money. That's
Make money
the
somewhere else.
make
Yeah.
money somewhere else, and it will be tax free basically. You'll be able to offset. But there is no really a magic
Yeah.
solution for
Uh,
that. It's just like make money and now you have basically a little bit of a tax shelter. You can think about it that way.
mhm.
And this tax shelter is your opportunity. So you might want to change the way that you think about making money. And focus on ways that you can utilize those kind of losses, um, basically against like you can just utilize those losses
Yeah.
against the future gains. That's the very simple answer. But
Ugh.
unfortunately, there are no magic solutions around that.
Yeah, so a lot of times, and I'd love to hear your experience, but people focus really on trying to turn their passive losses into active losses so they can use it against their income. But what I hear less about is turning their income into passive to be able to utilize that. So how have you seen people start making income or capital from in a passive way so that they can use losses to kind of offset the income taxes that they would pay on
So
money?
So it really depends what type of passive. So as in the beginning, like there are the two types. You have like the
Hmm.
source of income and you have the activity. So
Yeah.
just passive losses, sometimes
Hmm.
it's not enough. If
Hmm.
it's passive losses from a business, basically you invested, let's say that you're a physician
Hmm.
and you are a partner in a surgical center
Hmm.
or whatever kind of like a actual business it
Hmm.
is. The business that the income that or the losses. Let's say that you also like have some kind of on paper losses through
Hmm.
that business or on paper gains from that business. It doesn't really matter for that purpose. You
Hmm.
cannot really take those are ordinary losses and ordinary passive losses, and not just it's not like capital losses that you can take against capital gains. So you need like to understand. Okay, I have some losses carry forward. What type of losses? What's the source of those losses? How are they generated? And then you need, based on that understanding, you need to generate the profits from basically from similar source, similar similar activity in order to offset or to utilize those losses. And even then, you have certain limitations. There are limitations of how much of the losses you can basically utilize over time. But that's really what you want to understand. And it's so personalized for each person, depending how they created losses. Um, but but it's really nuanced at the end of the day. And
Hmm.
you really want just to analyze, okay, monitor what losses do I have, what kind of gains, and what are my opportunities in order to utilize those losses, and then actively pursue those opportunities in order to utilize it. That's kind of like the framework that you need to take into account. And of course, it's not easy either way. Like it's not that simple, and there is no guarantee. Obviously, that you will make money on any investment. So
Hmm.
but you want to adjust your strategy accordingly when you have those cases.
So the foreclosure loss, it's a capital loss and passive. So you need to find some capital uh passive gain, basically. So like stocks or other investments that have increased in value. And that's why like a surgical center doesn't work because that's not capital, it's ordinary. It's just like your
Exactly.
normal income.
Capital gains or capital losses happen when you sell an asset. So
Mm-hmm.
once the asset is being sold, like when you have an asset sale, like that's when you have that. If you're, by the way, if you own, if let's say that you own the surgical center and you sell your interest in the surgical
Mm-hmm.
center is an asset. If you
Mm-hmm.
sell
Mm-hmm.
that, and of course, like it's pure asset, you don't really actively participate in any of that. That might be useful. But capital gains or losses, they happen when you sell assets. But yeah, so that's kind
Yeah.
of like what you would be looking after. Accumulate assets that you can sell in the future for gains, for
Yeah.
capital gains in this case.
Yeah, but also if you have an asset that's making you a lot of money, don't necessarily say
Yeah.
sell it to
Yeah,
save.
taxes.
Yeah, well, but sometimes, like if you sometimes, depending on the assets and really depending on what it is exactly, let's say that like because people have, especially physicians, they have opportunities to invest in multiple things
Multiple
throughout
deals.
their
Yeah.
life. So if
Hmm.
let's say that they invested in a surgical center, everything went well, and after 5, 10 years, they have the opportunity to sell portion of that investment,
Hmm.
and then they have another opportunity to buy portion of like another surgical center. You might want to, sell some of one in order to reinvest in the other because you want also to diversify a little bit. You don't want to put all your eggs in one basket, like so
Yeah.
you want to create that kind of diversification. So opportunities happen all the time. Like it really depends on the circumstances of what you have, but you really need to have like a clear goal when you're doing that. Like you need to have number one, clear understanding about your situation and
Hmm.
your options, and number two, you need to have access to the opportunities, like to
Yeah.
invest in things like that. And then it's about timing, like making sure that then it's about like making sure the timing is right. So it is complicated. It's not easy.
So,
Yeah.
so I just thought of a idea. Say I own some shares on a surgical center. Could you do like tax loss harvesting? Can I sell it to use my depreciation or foreclosure losses and then just buy the shares all at market value and then just buy the same shares again?
So you
If
sell it
you
for a gain and then repurchase it?
Sell it for a gain, uh, and then utilize my losses to offset the taxes that I would pay. And then, so say I sell it for five and I have $3 worth of losses, so net two, and then I buy it for five again. Like so that instead, so I'm kind of letting those, like utilizing those
Well,
taxes. Yeah. So I'm
Yeah,
being
I'm
able
not
to.
sure. I'm not sure if wash sale
so
rules are
wash sale.
applicable for public
No,
for
it's all.
private
I was
stocks.
gonna say that
Yeah.
Yeah. Yeah.
you were actually mentioning this morning. Usually, you would have to worry about a wash sale if you're
Hmm.
selling and then repurchasing, but you're selling them for a profit. What's offsetting that profit is the capital losses that you have from, say, prior years.
Mm,
So you actually wouldn't trigger a wash sale that way
mm,
because you do have a gain on that
mm,
sale.
yeah.
However, I do want to like raise another concern around that, but and that's a great question. We will look into that. Intuitively, it doesn't sound right. So it
Yeah,
might be
yeah, yeah. I know.
it might be an artificial deal
Yeah,
that
yeah,
the
yeah.
IRS might not even like accept. So this in these
Hmm.
circumstances, like we would probably look into that and do a bit more research. But
Attorney, yeah.
intuitively, like it might be an artificial deal, and the substance
Mm,
over form might
yeah.
be a little bit different because practically you
Yeah.
didn't really sell the stocks.
Yeah.
Practically the money didn't really move hands to
Yeah,
or
yeah,
like
yeah.
in that way. So generally speaking, might be like on paper okay, but practically because there
Yeah.
is a little bit of
It did move.
shadiness,
It
let's
went
call
from
it
my
that
left
way.
hand to my right hand.
Yeah, from you to your in-laws to your parents and back to you.
Yeah.
But like again, I would need to look a bit more into that.
Yeah.
Intuitively, it seems that the IRS would not allow
Yeah.
something as obvious as that.
Yeah. Yeah.
It's a good
Okay, so
idea. I
yeah.
appreciate the idea. I appreciate the kind of like the approach.
Yeah. So someone asked a question. They are a limited partner in a deal that is going to go into foreclosure, uh, and there's going to be a loss. We don't know, obviously, fair market value, but there's going to be, at the end of the day, they're going to have a loss. And their question is, if they sold some Apple stock, assuming the numbers are the same, the gain is the same as the loss, would those cancel out each other?
Yeah, absolutely.
That was easy.
Typically when you're thinking about
Hopefully Nvidia, by the way, if the person has some like Nvidia.
Yeah.
so that's essentially your loss harvesting. So you
Yeah.
have a gain somewhere and you're offsetting it with a loss. Um, Depending on the timing, I usually would recommend, waiting till later in the year to do that loss harvesting. So just so that you know exactly where things are going to pan out and how many maybe you'll end up with a gain that you didn't have control over in some other place that would automatically offset that loss. So unless it is a really good time to sell, selling for the sole purpose of offsetting the loss so early in the year, might end up, running into different challenges as the year progresses.
Awesome. And then if I'm looking at a K1, how do I know like how much depreciation? Like how do I know what my value is in the property? They ask like if depreciation was done, but depreciation is done on every single property. But how do I know how much depreciation? I assume they're asking like if a cost segregation was done.
You probably can't see how much depreciation was taken
Hmm.
on the K1 itself.
Hmm.
But typically, so the depreciation is going to show up as it would be an ordinary deduction.
Hmm.
So if your K1 has ordinary income or rental real estate income or loss, usually if there was something like a cost seg, that income would either be way lower than it typically is, or potentially even at a loss.
Hmm.
One place where you can kind of see where you stand in that investment, and it's not exact, but it should give you a pretty good idea, would be it's in the like lower left-hand side. And it has your beginning of year basis. It'll say like current year ordinary income. It has like I don't remember exactly what the section's called, but there's a little
The
like
capital account?
is it called your capital account?
I think it's
Like in
like
the
your account. Well, basically,
it
when you
has your
say,
like beginning of the year investment, the ordinary income, the adjustments, and then your end of year balance.
yeah, the
Um,
capital account.
that can give you a rough idea into like where you stand with that investment. It won't tell you, if some of your losses are being carried forward, all of that's happening on your individual tax return. So you can't see those numbers from the K1 because the investment isn't
You
aware of
know,
it.
I think that I saw also like maybe in a couple of investments that they put description in the footnotes.
Sometimes they
Uh,
will.
but it's really dependent on the accountant that is like it's so dependent on the accountant who is actually doing the taxes
Yeah.
of the whole thing. So I would not kind of like over rely on that. Like it's not standardized. Like depending on the accountant, it depending how like and depending on the fund manager, like how strict the fund manager, how involved they are, and how much they care about the quality of the whole thing. So it really depends on those items as well. Um,
Yeah. If you're
but
looking for something specific, I would say the best thing to do is ask.
Yeah, ask the fund managers, or and if you really want, like and in general, it is recommended. Review your K1s. You don't need just to throw it at your CPA and let them deal with it. You want to, especially the big ones, especially the ones that you actually invested, like considerable amount of money in them. Review the K1s. Look at them. Look at the capital accounts. Look at the profit and loss accounts. See like the breakdown of income because you have a description of income on the right, the top right, the whole right side of the K1s. You have all the breakdown of different income and losses that the investment was generated. Take a look at that as well. Some fund managers also provide you with financial statements with the K1s. Like you will be able to see the financial statements of the investment, but there is no kind of like a law that tell them, oh, you need to do one, two, three. You need to share with them all of this information. It's really depending on like the fund manager, the property manager, how well it's being maintained, how clean the books are, how much they invest in bookkeeping, and not just like on the tax side. So it has a lot to do with that, which is always a good lesson. After you invest in enough of those, you kind of like see which ones are a bit more organized and structured and which one are still kind of like figuring out the right system for them. It does not mean that the ones that are organized will for sure generate better returns than the ones that are a bit less, but it's still something that you want to be a bit more cautious about that. And just look into that and educate yourself as much as you can when it comes to reading financials, reading K1s. I know that as physicians, you don't really have the time or will to do all of that. I cannot express how many times I tried to convince my wife just to sit with me and review our financials together. I told her, what happens if I get, I get hit by a car, or God forbid something happened to me? Like, like beyond friends and family, like it's really important that you have a basic understanding of money, especially when you start to accumulate good amount of it. So invest in your education and treat it as part of your professional development and not as like, oh, my financial advisor will do it for me, my CPA will do it for me. Like you invest in yourself, learn it, even if it's not the most interesting thing in the world, um, especially for, again, I completely understand that about physicians. My wife is actually going to San Diego this weekend I think that for the micros, there is some AMRS, something like that, some microsurgery conference, and one of the lectures there is about like financial education for physicians, one of the items in the conference. So definitely put some time and treat it as like a skill that you need to improve over time.
Awesome. Thanks, Tal. Appreciate your time. I know we're getting to the last hour. Sorry. I know we're going to send out Gelt's information. They're an amazing group to work with, and they really understand this stuff, not just from a CPA standpoint, but as in real estate investors themselves, and are helping many of their clients kind of go through the good and the bad, which we're in a little bit of bad territory right now in properties, but it'll turn around and they'll be there
We'll
just
get
to help.
better.
Yeah, yeah. And they're just as good as helping people get through the good when you have a lot of gains to figure out what to do with. So we'll send everyone their information. And if you're looking for a great CPA, they're a great firm to work with.
Thank you. Thank you. Appreciate the kind words.
Yeah.
But and thank you for inviting us. It was lovely. And again, it will turn around. It will be much better in the upcoming years. And the losses can be utilized in the future against gains, so it's not lost. It's not completely lost.
Yeah. Well, thank you, everyone, and have a great
Of
day.
course.
Bye.
You too. Have a good one.
Bye.